Hey everyone, welcome back to Corporate Decoder, the place where we untangle the sometimes messy world of corporate finances. And let me tell you, Plug Incorporated has a report for us today that is quite the story. Their latest filing is like a chapter in a business thriller, jam-packed with big numbers, big risks, and a whole lot going on. So buckle up, because we are diving deep into Plug Power Incorporated's Q3 results from 2025. Before we get into the nitty-gritty, if you love getting the real scoop behind company reports, hit that subscribe button and make sure you join our Discord community linked in the description below, where we break down these filings even further and chat about what it all means for investors. Alright, let's get right into the heart of it with Plug Power Incorporated, filing this as a Form 10Q, which is their quarterly report, covering the period up to the 30th of September. 2025. This is where we see the raw numbers telling us how the company is doing right now, month by month, quarter by quarter. Looking at their balance sheet, a snapshot of what Plug Power owns and owes at the end of September 2025, we see total assets standing at about $3.1 billion. That is down from $3.6 billion at the end of last year. Now, normally seeing assets shrink might raise a flag, but companies can strategically shed less profitable assets. What is important is understanding why. Their current assets, things they can turn into cash within a year, are sitting at about $1.19 billion. A big chunk of that is inventory, over $500 million. Now, having a lot of inventory can be good if it is flying off the shelves, but it can be a concern if it is sitting there not selling. What really stands out here is their restricted cash. They have over $189 million in current restricted cash and another $493 million in longer-term restricted cash. That is a whole lot of cash that the company can't immediately use to fund its operations. It is usually tied up for specific purposes like collateral for loans or guarantees. On the other side of the ledger, total liabilities are about $1.6 billion. Current liabilities, the debts due within a year, are just over $900 million. This means they owe more in the short term than they have in current assets. This can be a sign of liquidity pressure, meaning they got to be careful about how they manage their cash flow. Now, this is where things get interesting. Plug Power Incorporated has accumulated a massive deficit. That is a fancy way of saying they've lost more money over time than they've earned. Their accumulated deficit is a staggering $7.4 billion as of September 2025. To put that in perspective, that is almost double their total assets. This is a serious red flag for any company. Let's look at how the company performed in terms of making money or losing it. For the 3-month period ending in September 2025, they reported a net loss of over $363 million. And over the first 9 months of 2025, that loss balloons to almost $789 million. That is a huge amount of red ink. To compare, in the same 9-month period of 2024, they lost about $769 million. So while they're still losing money, the rate of loss has increased this year. Their net revenue is actually up a bit, reaching over $177 million for the quarter. A slight increase from last year. Over the 9 months, revenue is around $485 million, up from $437 million in the same period last year. This is positive, showing they are selling more. But here is the kicker. Despite selling more, they are losing more money on the goods and services they provide. Their gross loss for the quarter was over $120 million. And for the 9 months, it is a massive $247 million gross loss. That means the cost of making and delivering their products is higher than the money they get from selling them. This is a major concern. When we look at their operating expenses, research and development costs are down, which might be a strategy to cut costs, but selling, general, and administrative expenses are up significantly. This is largely driven by restructuring costs and some serious impairment charges. They recorded almost $100 million in impairment charges this quarter. That means they had to write down the value of some of their assets because they are no longer worth what they thought. They also had significant impairment charges on property, plant, and equipment, and even on contract assets, which means they don't expect to collect all the money they are owed from customers. This points to serious issues with their projects and customer contracts. And then there is the interest expense. It is up significantly, largely due to new debt they've taken on, like that 15% secured debenture. Paying interest on this much debt eats into any potential profits. This brings us to cash flow. The cash flow statement shows us where the money is coming from and going to. For the 9 months ending September 2025, Plug Power used nearly $387 million in cash from operations. That is an improvement from last year when they used almost $600 million, but it still means they are burning through cash. Investing activities show how much they spent on things like property and equipment. They spent about $118 million on investments in the first 9 months of 2025. That's less than the nearly $359 million they spent last year, which might be a sign of them conserving cash. Financing activities show how they raise money. They brought in over $313 million from financing in the first 9 months of 2025, less than the nearly $779 million they raised in the same period last year. This big drop in financing is largely due to them raising less money through public offerings. Let's talk about their access to cash or liquidity. The company states they believe they have enough capital to operate for at least 12 months. This is a crucial statement, but they hinge this belief on several factors: forecasted sales, their ability to sell more stock under their at-the-market programs, and their ability to access more debt. This sounds like they are relying heavily on future fundraising and debt, which can be risky. They issued a significant amount of debt in May 2025, that 15% secured debenture. That is a really high interest rate, meaning it is expensive money. They also sold more stock in their at-the-market program. This all points to trying to plug holes in their cash flow. Back in March 2025, they raised quite a bit of money by selling shares in warrants. Warrants are like options to buy stock later. These financial instruments can be complicated, and their valuation is key. And then after the quarter ended in October, they did something called a warrant inducement. This is essentially a deal where they got the holders of their common warrants to exercise them early, and in exchange they issued new warrants and pre-funded warrants. They raised a substantial amount, over $355 million from this. This shows they are actively managing their capital structure. But it also highlights the constant need for cash. The company announced a restructuring plan in March 2025. This involved workforce reductions and streamlining operations. They incurred about $5.5 million in restructuring costs this quarter, and over $25 million for the 9 months. While restructuring can lead to future savings, it also indicates current operational difficulties. And speaking of difficulties, those impairment charges we saw earlier are a big story. They're hitting multiple areas: property, plant and equipment, contract assets, even right-of-use assets related to leases. This suggests that their long-term investments and projects aren't performing as expected, and they are writing down their value. Their intangible assets like acquired technology are also showing some impairment. This indicates that the value they assigned to these assets at the time of acquisition is no longer considered valid. They had a significant loss on their equity method investments, over $42 million in the 9-month period. This resulted from an other than temporary impairment on one of their investments, meaning they don't expect the value to recover. The company's debt is a big talking point. The 15% secured debenture that they took on is a high interest loan, adding a significant financial burden. They have about $241 million in long-term debt, with a good chunk of it due within a year. They also have convertible debt, which can be converted into stock. The 7% convertible senior notes are classified as current liabilities, meaning they are due within a year. This is another major financial obligation looming. Now, it's important to know how the company views its business. Plug Power only reports one operating segment: hydrogen products and solutions. This means all their revenue, costs, and investments are considered part of this single business. Their Chief Executive Officer, Andrew Marsh, is the chief operating decision maker. Looking at specific revenue streams, sales of equipment, including things like electrolyzers and fuel cell systems, saw a decrease in the third quarter of 2025 compared to last year. This was mostly due to fewer hydrogen site installations and reduced sales of engineered oil and gas equipment from an acquisition. However, sales of electrolyzers did increase. They're also making provisions for common stock warrants related to agreements with Amazon and Walmart. This is basically setting aside money to account for the potential dilution or cost associated with these warrants. These provisions are reducing their reported revenue, so they are having a direct impact on the top line. Now remember that gross loss we talked about. A big driver of that is the rising cost of revenue, especially in their equipment sales. They've had to significantly increase their inventory valuation adjustments, meaning they are writing down the value of their inventory due to excess or obsolescence. This is a big signal that they might have produced more than they can sell, or that the market has shifted. The impairment charges are everywhere in this report. It is a consistent theme that their assets, whether they are physical equipment, intangible rights, or even the money customers owe them, are not holding their value. This points to underlying issues with project feasibility, market demand, or contract execution. The company does not shy away from risks in their filing. They highlight the risk of continuing to incur losses, needing more capital, potential delays in product development, and the uncertainty of securing hydrogen supplies. A particularly noteworthy risk is their decision to temporarily suspend activities related to the Department of Energy loan program. This program was meant to provide them with low-cost capital for building green hydrogen facilities. By suspending it, they risk losing this important funding source, potentially delaying projects and increasing their overall cost of capital. They also mentioned that it could be viewed negatively by other potential partners and lenders. This is a bold move, and the consequences could be significant if they cannot secure alternative funding on favourable terms. So, what is the overall picture here? Plug Power Incorporated is in a tough spot. They are growing their revenue, which is a good sign that there is demand for their products. However, their costs are ballooning even faster, leading to massive gross and operating losses. They are burning through cash at an alarming rate, and their accumulated deficit is enormous. The significant impairments across multiple asset categories indicate that their past investments and projects are not panning out as hoped. Their reliance on ongoing equity and debt financings, including high-interest debt and complex warrant structures, shows they are in a constant battle to fund their operations. The suspension of their DOE loan program activities is a particularly concerning development, as it removes a crucial avenue for securing vital funding. While the company is innovating in a crucial sector like hydrogen, the financial realities presented in this report are stark. They need to demonstrate a clear path to profitability and sustainable cash flow generation, and fast, the increasing impairments and the high cost of their debt are significant headwinds. What is your take on Plug Power's situation? Are they on the verge of a turnaround, or are these losses a sign of deeper trouble? Let me know your thoughts in the comments below. If you found this deep dive valuable, hit that like button to support the channel, and subscribe for more breakdowns of essential corporate filings. And remember, join our Discord community linked in the description for more in-depth discussions. Thanks for watching, and I'll see you in the next one.